Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to talk to you a little bit about company valuation. And this is specifically around an investment topic. It was spurred a little bit by some back and forth I was having with somebody on Twitter, and they were making some comments, which I will cover later, that kind of demonstrated what I would say is a lack of understanding about how valuation works, and therefore that can affect your investment decisions and cause you to, just not do as well with your money as you might otherwise do. So I'm going to try over the next while to do some more specific investment type related videos. By the way, if there is videos that you would like to see, please let me know. You can put them in the comments below and we'll record them and see if we can put something else out there. Always want to support what it is that you guys are interested in. But I think this is a really important topic. If you're at all familiar with the idea of value investing, the principle behind value investing fundamentally is to find what the intrinsic value of a business is and buy for less than that with a margin of safety. So this is popularized by Ben Graham, his book Securities Analysis, which is big and super thick. There's a more digestible version called The Intelligent Investor that you can read. It's probably the most recommended book that Warren Buffett has. Warren Buffett famously studied value investing as his base and then added on growth investing, which is kind of pioneered by Phil Fisher. There's a book, Common Stocks, Uncommon Profits, that you can read to kind of get some idea of Phil Fisher's kind of insights, although both of those have been expanded on in great detail in kind of the subsequent years since that sort of information was pioneered and written, etc. Anyway, I'm going to explain a little bit about how to think about valuation, what valuation is all about, and hopefully this helps you make better investment decisions, just understand kind of the world and markets, etc. a little bit better. And if you're going to do sort of private deals to buy private companies or sell companies, etc., it may help you out there as well. So let's dive in. Before we do, if you're not, please hit the subscribe button, hit the all notification bell, do that little ding thing so that you get reminded all the time when we post a new video. If you like the videos, give them a thumbs up, share them with your friends. Really appreciate your support. And if you would like help, or if you've not been here and don't know what we're about, I'm Michael from Offshore Citizen. We specialize in custom holistic international solutions for both individuals and businesses, helping you with global tax optimization, international banking, getting residencies, citizenships, relocating abroad, designing plan Bs and ultimate lifestyle solutions for you, etc. So if those things sound interesting to you, you can please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below. Or you can send a message through offshorecitizen.net. Okay, now that we've gone through all of that, let's talk a little bit about valuation. Now, just a quick note of kind of the context for this was a person was making the observation that Tesla is worth 10x more than Ford. That is to say their market cap is 10x more than Ford. And Ford sells 10 times more cars than Tesla. And this was an indication of just how out of whack things were and how overpriced Tesla is. Now, to be fair, Tesla perfectly well could be overpriced. In fact, I personally do not buy and I dollar cost average over the last, month and a half or something. Every single day I have a portfolio of stocks that I'm buying, and Tesla is not among it. Not because I don't like the company, not because I don't like Elon Musk. I think it's a terrible idea to bet against Elon. That's an awful idea. But because I just think it's an overpriced company. So I just don't think that the upside relative to the current price is particularly great. This being said, I think it reflects a misunderstanding of how valuation works. So let's just start with the super basics, which is what is valuation, what is market cap? Market cap is the number of shares multiplied by the price per share. So sometimes people will talk about the price of the share. They're like, oh yeah, it's at $15. This means zero, like zero in itself. Unless it's a comparative to like, oh, hey, it's up 50% from what it was before, or it's down 50% from what it was before, whatever. The stock price is not really, it itself doesn't mean anything, right? Because you could just have, 10 times more stock shares and have 1/10 the price per share, or you could have 10 times fewer shares and have 10 times higher stock price. The market cap is really the much more meaningful number, okay? So number of shares multiplied by price per share equals the market cap. That's number one. Number two, this is representative of what it would take to buy the whole company. And so as Warren Buffett and Ben Graham and these guys point out, is when you're buying a share, you're not buying a share, you're buying a piece of a company. And By the way, this is something that I think people get wrong with crypto as well, is they think like, I'm buying a token, the token has no value. It's like, well, when you're buying a token, you're not necessarily buying a token, you're buying what the token represents. In some cases it represents nothing. In fact, in a lot of cases it represents nothing, but sometimes it does, and then what matters is what does it represent. So the same is true here. You should be thinking about the business, not about the shares. The shares do have, like, instruments do matter when we're talking about investing instruments, but it's not the primary thing when we're talking about this. So we're thinking about the underlying asset, and the underlying asset is the business. And so what is the business made of? Well, it's made up of actual hard assets. It's probably got cash equivalents. It's got, brand value. It's got various intangibles. It's got network effects. It's got users, customers, suppliers, supply chains, all of that stuff, right? And so what we're conceivably saying is that all of that stuff, the market is saying is worth this. And the good news about that, by this I'm saying the market cap, right? The market cap is a measure of what the market is saying all of that together is worth. So all of Tesla's factories, their engineers, their systems, their processes, their brand, their whatever is worth whatever the current today Tesla market cap is. And of course, that's going to fluctuate as people kind of disagree over the company. Now, in theory, the way that you could kind of figure out what you thought the intrinsic value of the company was, you could write down everything the company has, and you could assign a value to it, and you can add all of that up, and you can say, okay, here's my idea of the value. And so some of the things we've used traditionally, like if you were to look at Ben Graham, he used something called net current asset value. Now, net current assets are like you can easily sell them. And so net current asset value is far, far, far lower than the actual business value in most cases. But that being said, it was a way of, his metric at the time was if you could buy for a 40% discount on net current asset value, you could pretty much always make money. Because basically you would buy the company or buy a share of the company, you would lobby to have those assets sold and the proceeds distributed to the shareholders, and you'd make this return and off you could go. And he beat the market by a bit by doing this, right? He was an activist investor. That's not a very viable strategy today. A more supposedly realistic view of this is book value. Okay, so what is book value? Book value is basically what's at the bottom of the balance sheet, right? So if you say assets plus or minus liabilities equals book value, that's basically what you're talking about. The problem with this is financial statements today, book value, do a poor job of capturing a lot of intangible value. So for example, brand value is difficult to capture on a balance sheet. Network effects are difficult to capture, et cetera, et cetera. So tangible assets tend to be pretty easy. You can depreciate them over time. You can, do things like that. Same thing with actual cash and cash equivalents. Same thing as debt, right? We know what the value of the debt is, et cetera. But when we're talking about something like, again, brand value, what's the brand value worth? What is, we know that there's a lot of value in the users on Twitter, but how much is the book value of Twitter, right? So this sort of thing is, book value is not a very good proxy for that. So you would need to somehow figure out these other things and come up with some idea about what that was worth. And this is not that easy to do. So what we resort to instead, in most cases, is some sort of other price to earnings or price to sales metric. And this is very sensible, because if you think about it, what you're really thinking when you buy an asset is, what is it going to give you over time, right? In other words, let's just use the example of a bond. A bond is the easiest equivalent. If I go and I buy a bond for $100,000 and that bond is paying a 3% interest rate, then over 5 years, I'm going to get 3% interest per year. So I'm going to get basically $15,000 and plus $100,000. And so if I know, okay, the future value of this bond is going to be $115,000, then I can buy at a discount from that, and I can kind of calculate what is the discount rate I want over time. So what does that mean? What this means is if I buy it for $100,000, then my discount rate is basically 3%, right? 3% per year is what I'm going to get as a return. But if the price of that bond drops to $50,000, right? Well, now over those 5 years, it's going to more than double. This is pretty good. I'm talking about, over 20% a year gain that I'm going to be getting by buying it now. So this is a pretty good deal, provided I actually believe that this is in fact going to pay out that money, that there isn't a credit risk, right? I'm not going to be in a situation where, well, one of two things is going to happen. One is either they're going to fail to pay, they're going to default, and I might actually lose the money. Or two, the inflation rate is sufficient that the value of that money in the future is going to be dramatically lower than it is today, or at least not sufficient enough to compensate for that risk. So hopefully this is kind of making sense to you. That's like the basis of the basic thinking here. And so when we buy a company, the Warren Buffett idea is that you're buying like an equity bond, right? So you're thinking, okay, well, I'm buying a thing that has value, and so I have that value in the future, I can sell it, but also it's going to pay me cash flows into the future. And so what is the collective value of all that cash flow that I'm going to get over the next 10, 20, whatever years? And that's going to give me some idea of what this company is worth, right? So this is where we get something called price-earnings ratio. Price-earnings ratio is the current stock price divided by the earnings per share. In theory, it's basically like the total profits of the company divided by the total market cap of the company divided by the annual profits. That's kind of a loose gauge that you can use. Buffett uses something called owner's earnings as opposed to actual stated earnings. And the bottom line is that there's ways to manipulate earnings within financial statements, and so you have to kind of be aware of that. You also could potentially experience dilution. So, for example, it's pretty normal that in a lot of big tech companies, they'll dilute the shares by about 4% per year. And the reason for this is they're giving out stock-based compensation to employees and things like that. So they've got that ability. Then on other cases, you've got the opposite, like Apple is buying back shares every year, so they're actually reducing the number of shares. So anyway, there's some things that can happen in this regard. The whole point is that you're trying to get some sort of a value, and the value should make sense based on this future cash flow, okay? Now, why do I give all that preamble to go back to this example of Tesla versus Ford? Not to say whether Ford is a good deal or Tesla is a bad deal or vice versa. That's not really the point here. Maybe in the future I'll go through and do specific analysis on one company or another. If you're interested in that, let me know. Put it in the comments. Would love to hear. But to say, well, the number of cars sold really isn't a very meaningful metric of that value if you're looking into the future. So let's just kind of start by understanding that markets look into the future. And this is just really logical, right? Because if you're saying, okay, well, today you guys are making $1 billion a year. Okay, so let's just say that a reasonable price earnings ratio in the market was 20 times. Okay, so what would that mean? If I'm making $1 billion a year in profit in a company, then and a reasonable multiple in the market, based usually on comparative investments, is 20x, that would mean that I should have a valuation of $20 billion. Okay, I don't have to worry about adding up all these assets and all this sort of thing. I realize that $1 billion a year for 20 years, that's $20 billion. That's what I kind of figure it's worth given a reasonable discount rate, which is probably something like 5% a year, which is kind of based on the current interest rates, right? So as interest rates rise, the comparable rate that you're comparing to, in other words, like if I can go to the government, I can get a government bond that's paying me 10% a year, well then why would I go to a company and take 5% a year, right? I'm taking on risk in the case of the company, but I'm not, at least not credit risk in the case of the business, or in case of the bond. And so this is measured to that. So some that will be variable and depends on future expectations about credit about interest rates, etc. But loosely speaking, let's just have this idea. Okay, so you've got $20 billion. Okay, well, but what if I think that this company is going to grow at a rate of 100% a year for the next 5 years? So the next year, it's going to put out $2 billion a year, and the year after that, $4 billion a year, and the year after that, $8 billion a year, and the year after that, $16 billion a year, etc. Well, does it make any sense to pay $20 billion for a company that is going to do that? No, of course not, right? Absolutely not. Instead, I should be thinking, well, if I run the math, let's just say it was going to double each year for 5 years, and then for 5 years go steady, right? Well, I've got $1 billion, $2 billion, $4 billion, $8 billion, $16 billion, right? So already we're at, what is that, like 31 billion. So we're at 31 billion, plus we're saying for the next 5 years, we're going to get 16 billion a year. So that's another 80 billion. I'm basically saying that over the next 10 years, I'm going to have value of around $110 billion, right? So if it's going to be worth $110 billion over the next 10 years, why would I only pay a $20 billion price for it, right? I'd probably pay more. And so this is why as growth increases, the multiple will increase. And you'll sometimes see multiples in the hundreds, right? Likewise, what if you think that, okay, it's making $1 billion a year this year, but I think next year it's probably going to be half of that. And the year after that, it could be losing money. And I actually think that it's going to zero. Well, then what would you pay for it, right? You'd probably only pay something like the net current asset value because you can just strip it out right now, sell it, and off you go. So this sort of approach, it's important to realize this. And so if we compare Ford to Tesla, it's not important really at all how many vehicles they're selling. What's important is, first of all, how much money you're making off of that. And it turns out Tesla's profit margins are much better than Ford's profit margins per vehicle sold. Okay, so right off the bat, if I'm selling 1/10 as many cars, but for instance, I was making 10 times more money per car sold, well then I should in theory have the same valuation, all else being equal. And of course we know that all else is not equal. Second of all, Tesla is growing at about 50% a year, right? So with a growth rate of 50% a year, if we fast forward that 10 or 20 years into the future, obviously you're not going to have continued growth at that rate. You're going to hit you'll have sort of an S curve probably of growth. But you've got a pretty high rate of growth compared to what's Ford doing. Ford's probably not growing at all. In fact, they might be declining. I mean, if you consider that Ford's share price, okay, just consider how bad this is. Ford's share price in 1997 was comparable to what it is today. In 1997. Now, I don't know why they don't go and physically tear the board members and throw them out there, and the shareholders should be furious at these people. By the way, the CEO gets paid $19.4 million a year, approximately. And this is the performance that you've had. So it's pretty reasonable to think, well, Ford's share price hasn't done very well for the last over 20 years, 25 years. Do I think that they're going to do particularly well in the next little while? No, probably not. So what am I going to do? Well, I'm probably not going to pay a very high multiple for Ford shares. I don't really care. They aren't showing growth. They aren't returning much of value to shareholders. So why would I buy this company? This seems like a waste. On the other hand, what is Tesla doing? Well, Tesla is growing at 50% a year. They're doing super cool stuff in manufacturing. They're rapidly expanding. They're basically 6 companies in one. They've got, full self-driving, which they can license out to some others as they kind of improve on that. They've got the car business. They've got the solar panel business. They've got the supercharger business. They've got possibly the Tesla roof business. They've got these robot things that they want to build. There's so much. They've got the Dojo AI training system in there. I mean, there's so many things that they're already doing, each of which could become its own business that could grow. You have to look at the entirety of this, not just the cars, and say, well, where are they going to go? Are they going to be able to improve their margins? Maybe. Okay, well, that would mean that you would expect them to have a better return. Are they going to sell more cars over time? Yeah, probably. Probably the number of cars is going to go up a lot. Probably over 10 years, there's a reasonable chance that they're going to be selling more cars than Ford. So then if I'm thinking into the future, if I'm forward valuing this company, why would I ever pay the same price as I would for Ford if Ford's going to sell the same number of cars or less, and Tesla's going to sell the same number of cars, whether it's 5 years or however many years into the future, they're going to match them on cars. And if Tesla's making more money per car, then I'm thinking that as well. But then Tesla's not just doing cars, they're doing a bunch of other things, and I have to account for all that as well. So the bottom line is, you need to think into the future, not at present. Present really doesn't matter, right? You can be, second of all, you have to be thinking about profits, not sales. Now, yes, you have to think about future profits. So there's a lot of companies that are maybe losing money this year that frankly are probably going to be really profitable in the future. This was the case with Amazon for quite a while. Amazon was really good at reinvesting their money internally, and for a long time wasn't showing any profit. And suddenly they started pumping money out like crazy, and good for them. That was a well-managed company. So we have to kind of understand what's going on with their gross margins, and what's their ability to scale up, and are they deploying money into growth and reinvestment that's going to produce more returns for them. What's their return on invested capital? There's all these different things that do matter quite a lot. But I think the important thing to understand is when you're looking at a company, pay attention to what's going to happen in the future. Obviously, this is where the guess comes in, right? We have massive uncertainty. What's Tesla going to do 10 years from now? Who knows? They have massive key man risk, right? If Elon dies, this is probably really bad for the company. Like, probably the shares should be worth half or less if Elon dies at this point in time. On the other hand, he could be there and they could continue to do great and grow, etc. And you have to price that in. Again, I tend to think it's overpriced. In fact, Elon has publicly tweeted that he thought it was overpriced, and then people went and bought more and pushed the price up more. So, what can you say? But anyway, the bottom line is just that I think forward-looking, okay, focused on profits, and not focused on today's profits, but focused on, okay, as we scale this up, where does the profitability go? What is the growth in the overall market? What is the positioning within that growth, right? So in other words, if we look at electric cars, over time electric cars are going to grow as a share of the overall number of vehicles sold. And what is the Tesla share of that growth that's going to exist? And then let's look across all the verticals of the business, not just one. I hope that's helpful. I hope I didn't kind of make it too confusing or something. Please let me know if you have questions, put them in the comments below. It's like a really complex subject, and frankly, nobody's like actually able to figure out really like what the absolute number is. And so you kind of have to make some guesses about, okay, here's what I think, and here's the assumptions that I have, and based on those assumptions, here's how I'm trying to figure this out. Here's what's knowable, here's what's not knowable. Here's probably a range of outcomes. And so based on that range of outcomes, I figure I probably can't say, this is a $200 billion company. I can probably say it's somewhere between 250 billion and 100 billion. There's got to be like some range of outcomes that makes some reasonable sense, and then make the decisions according to that. But in theory, the way that a lot of the best investors have made investments, and in fact, there's something called 5-factor investing. I'll maybe do a video about it in the future. One of those factors that has been proven to outperform the market is value. And so value is essentially buying for less than what these things are worth. Like I said, Buffett and a number of others have popularized that idea. And so you want to figure out, okay, well, what is the value of the company? Not today, but over time. And am I buying at a substantial discount from that? Buffett would call it, paying $50 to buy $100 bills. Anyway, I hope it helps. If you like it, let me know. If you don't like it, let me know. Tell me I'm an idiot. Appreciated. Tell me why would be better. And if there's little insights that you have to share about the subject of valuation, please put them below. I will look forward to seeing you on the next video.